In my opinion, IPOs are one of the best places to make money in the market. There is very low risk and there is high upside if you do it in the right way. And this has been recently proved by the Tata Tech IPO, for which the IPO price was just 500 rupees and the day of listing it closed more than 1300 rupees. So you can calculate the returns there, right? And after this, a lot of people ask me, hey Ajay, why did you not suggest this IPO? This was such an amazing deal that if I invested, I would have actually gotten a lot of money from it. So without further ado, let's get right into the video. The name is Ajay Ajit. Welcome to MarketFeed. So an IPO or an initial public offering is nothing but a company selling its shares to public shareholders for the very first time. They might use this IPO money to fund future products. They'll take the money into the company. It is called as fresh equity issuance, and sometimes the existing promoters, the earlier promoters, they might be exiting through this IPO, and it is called as an offer for sale. So most IPOs that you see will have both components. There will be a fresh equity component as well and a offer for sale component as well. So what if I told you that despite all of this, the company taking in money for its growth, the promoters exiting, all of this, leave it aside, there is a surefire checklist which if you follow, the chances of you making profits from an IPO are more than 90%. So one thing that you'll have to agree with me here, whenever you're applying for an IPO, you will only do it for the listing gain. Okay, if that is clear, let us move ahead. Because when you're applying for a listing gain, it means that you'll apply for the IPO. If you get the IPO, you'll be selling it on the listing day or very close to it. You'll not be holding it for the long term. And if you're a long-term investor, I'm telling you that the IPO is not the place for you. Two specific reasons there. The first reason is that IPO allotments come in lots. So suppose you want to give nearly 10% of your portfolio allocation to this very shiny new, let's say a Tata Tech IPO which is coming up. Your total portfolio is worth 10 lakh rupees and you want to allocate 10% of that into Tata Tech. But as a retail investor, how much shares are you eligible for getting? Because whenever an IPO is oversubscribed, you'll only be getting one lot worth of shares. That means nearly a 10 to 15,000 rupees worth of shares is what you'll be getting, and the rest 85 to 90,000 rupees worth of stock that you wanted to allocate, you'll still have to buy from the open market after the IPO listing is done. That means a long-term investor should never look at an IPO to get started with their investment journey. So that's clear. Long-term investors stay away. The strategy that you will be deploying, it's only for listing gains in IPO, and it is very straightforward. You can use this to analyze any IPO which is coming out into the market. You don't have to know much about the company. You don't have to read their draft red herring prospectus or their multiple annual reports. Just do these two things. The first thing that you'll have to watch out for is something called as a gray market premium. That means you are an early employee and you got the shares from the company as compensation for you working there, and now you don't know what to do with it, right? You have the full freedom to do whatever you want with the share, and hence you decide to sell it on the secondary market to someone on the open market. Think of it as someone selling movie tickets or concert tickets on the black, right? Trying to flip it for higher profits. Just think of it like that. So the gray market premium indicates how much premium the black market rate or the gray market rate is going on than the compared to the IPO price. So let's say Tata Tech's IPO price or the IPO issue price is coming out at 500 rupees and the grey market premium is called to be 100 rupees. That means that 100 by 500, nearly 20% grey market premium is being charged on the stock, and that is a potential way to make a listing gain for you. So the second thing that you'll have to watch out for when you're getting into an IPO for listing gain, again we agree, right? All of us are here for listing gain. The second thing that you'll have to watch out for is oversubscription. Let's look at what that means. So for every IPO, there are different types of investors, right? And there have been made certain classifications for which you can apply based on the kind of investor that you are. If you're a retail investor, you'll have to invest in the retail category. If you're an HNI means you'll have to invest at least 2 lakhs into that IPO. If you're an HNI or even an NRI, there is a separate category for you. And the third and most important category is the QIB category, which is a qualified institutional buyers. So these are who we call as intelligent institutions, the one who control the market, right? Not the retailers, not the HNIs, these are who you should be going after. And a decent amount to look here is at least 5x oversubscription in the QIB segment. Anything above that is even better. If 10x, 15x, 20x, 30x, all of that is just making sure that the IPO will be a blockbuster on the listing date. So what do you have to do? You have to stay away from all the hype. Just track these two things. One is the grey market premium. The second one is the oversubscription by qualified institutional buyers. And this is all you have to do. Stay away from all the hype. Apply on day 3 after you see that there is a good qualifying institutional buyer activity for the IPO. There is no bias given between the day 3 and the day 1 subscription that you do. Just apply on the last day, it is okay, right? And one thing that you have to note, do not try to apply from multiple demat accounts under the same PAN number. It will automatically be cancelled. So if you want to apply for multiple lots, do it from maybe your account, your brother's account, your mother's account. Do not try to do it from, say, your Zerodha account, your IAFL account, your Grow account. Do not try to do that. That will automatically cancel your IPO subscription. So once this is all done, is the conclusion very clear? It is a sure shot, almost a sure shot strategy at making money from the market. In fact, I would say it is the most successful strategy for making money in the market, right? But then what is a con here? What is a disadvantage here? What is the catch here that you'll have to know for? So let's get into the proof for this strategy. So the only thing available right now is the QIB and the oversubscription percentage. You can assume that if there is good institutional investment or interest, there will also be a good grey market premium as well. So here on the left side, we have all the IPOs which have happened till 15th November back till even 20th March, right? March 2020. That's what we have right here. So here you can see the company's name, the listing date, the qualified institutional buyers, how much X, that means 1x means if they have 100 shares available, 100 people have applied for the IPO, that means 1x. Here 142x means that for every 1 share of the company that was offered to QIBs, nearly 142 people applied for that. And here you can see the listing gain as well. So this is currently sorted by date. Let's go ahead and sort it according to the percentage or the multiples of QIB investor interest, right? So we'll go here, we'll go to data, we'll go to sort sheet, right? And we'll go to sort this column, right? So right now I'm sorting by how much qualified institutional buyers have oversubscribed to the IPO. So again, 200 means that for every share, there are 200 people applying for that share. So I've sorted it according to that. And here the trend is very clear. Whenever the QIB is very high, you can see this, right? I'll remove the first few lines which does not have the enough data here. Whenever the QIB is very high, the listing gain is also extremely high. You can see here 82%, 60%, 35%, right? And the list goes on. I cannot even see, I think this is the worst which has happened with a QIB of 142x and then a listing gain of only 7.5%. Still, I would say it's a good number, right? Even going down. There are some cases where there have been losses. Yes, it's not a 100% profit strategy, but still, and you can see that out of the most of cases where the QIB has been more than 10x, there has been good listing gain as well. So this is something that you'll have to watch out for. I've shown you with proof, right? So you'll ask me, hey, what is the catch here? A strategy which has so much possibility of working, why is everybody not doing it? That is exactly the problem that I want to discuss here. Since everybody is kind of going with the same train here, the probability of you getting the IPO itself will be low, right? That means if it is so oversubscribed, it comes into a lottery question. Who will get the IPO first will be the question. And if all these checklists are being approved, I would say go ahead blindly and apply for the IPO. It would most likely be the case where you get a lottery ticket, and if you're getting the IPO allotment, you can sell it on the listing day itself and get the gains. So now you don't have to go and ask anyone, is this IPO good? Is this IPO good? You don't have to worry about any of that. You can just go ahead, follow this checklist and hopefully make a good listing gain on the day of the IPO listing. Subscribe to this channel if you haven't already, if you want to get access to strategies, tips and analysis like this. This is Ajay signing off. See you all again. Bye bye.